I want to thank everybody for taking the time out of your busy spring market in August to join us today for a very special guest, Jason Mercer. I'm going to talk a little bit about him, but first and foremost, he's a gentleman who I've worked, and Larry has worked side by side with, very knowledgeable. Jason Mercer is the Toronto Real Estate Board's Chief Market Analyst and Director of Service Channels. He leads TREB's market analysis program that provides products and services that help realtors and their clients fully understand trends in the GTA housing market and underlying economic drivers. Jason also manages the delivery of information and data products to the TREB membership. Jason has private and public sector experience in the real estate industry, having previously held positions at PricewaterhouseCoopers and the one we'll be talking about today for sure, Canada Mortgage and Housing Corporation. He possesses a Bachelor of Arts degree from Simon Fraser University and a Master of Science in Planning degree from the University of Toronto. Jason is a member of the Land Economic Society, Lambda Alpha International, and a member of the Ontario Professional Planners Institute. And he's also a Vancouver Canucks fan, and the Vancouver Canucks are in the playoffs. So we won't analyze them. We'll stick to analyzing. The real estate market because I think it's sometimes easier than the hockey market. So anyway, Jason, I want to thank you so much for being here and being part of this. And I'm looking forward to hearing you speak to our team of professionals.
Sounds good. So should I just take it away?
Take it away.
All right. So what I'll do, I'll turn off my camera while I'm presenting just in case bandwidth issues come into play or something like that. And then I'll turn it back on for the Q&A. At the end. So I'll do that now and share my content. And if you can just let me know if you can see it once I share it here. Just one sec.
I'm probably going to go up on your Not yet.
So hopefully you can see the PowerPoint now, or?
Yep, we can see it.
Okay. And still now that I went into presentation mode?
Yes.
Yep. Okay, good. So one thing that I have found, I'll say in advance, I'll send a PDF copy to you because I've found that depending on the day and if there's been an app upgrade, sometimes some of the fonts go a little bit wonky, and I know people watch these things from their TV down to their iPhone. So, you know, sometimes some of you may have difficulty seeing some of the screens, but rest assured, I'll send a PDF version through to Tim and Rebecca and Larry, and they can pass it around the brokerage as they see fit. Does that sound good?
Good.
Great. Okay. So what I wanted to talk about, I'll talk for about half an hour or so, a market update and a bit of an outlook update as well, as we're sort of in the early first couple months of what we hope is a sustained recovery, both in the economy broadly, but also in the housing market, in particular in the Greater Toronto Area and across the country. And I've broken the presentation down into sort of 5 key parts that'll flow into one another. We'll take a quick look back at where we've been, sort of looking at the COVID-19 timeline and some of the key events that transpire to impact the economy and impact the marketplace. We'll look at some key economic drivers, obviously including the labor market, which has been top of mind as we went into a massive economic shutdown, and now we're seeing things open up. We're in stage 3 now across the Greater Toronto Area, so we'll talk about what that means for the labor market. Obviously, when we're thinking about the housing market, borrowing costs are a major factor that impacts affordability. So we'll talk about both where the Bank of Canada has gone and also how that's translated through into longer term interest rates in the bond market, and obviously how that then impacts mortgage rates that your clients are taking advantage of to purchase and pay for a home over the long term. Apologies here. And then on top of that, we'll talk about, as Tim alluded to, obviously how that's fed through into our own statistics through TREB's MLS system. And I'll look at that both from an aggregate perspective, sort of looking at total sales and listings, but then also sort of breaking down, how how there's been a bit of, I guess, an asymmetry in the recovery that we've started to experience over the last couple of months. Because while sales were strong in June and even stronger in July, and we saw accelerating price growth, things did unfold exactly in a uniform manner across the different segments of the housing market. So we'll talk about that in a little bit more detail. I do want to speak to the CMHC, both the changes that were announced a little bit earlier on, but then also the story that was in the media yesterday. And I have some thoughts on that. Some of it comes from some of the polling that we've been doing on a regular basis through Ipsos, that sort of tracks where people are headed in terms of down payments and that type of thing, source of down payments. And I always find that there's some misconceptions around how leveraged the average home buyer is, even the average first-time home buyer. So I think it's important to present that side of the story as well. I'll look at the broader Ipsos consumer polling numbers, intentions to buy, intentions to list, that we undertook both in March and April as we were sort of moving through the early days of COVID, just to get a sense as to where people were headed. Generally positive figures out of there, and then finally a bit of a forecast update. So I'll jump right in, and let's start with the COVID-19 timeline. And it's interesting that equities markets. So this chart is plotting out the S&P TSX from the beginning of 2020. And it's interesting, actually, the trend that we saw unfold in equities markets was actually a leading indicator of what we'd eventually see in the economy and to a great degree the housing market. A few weeks later, because essentially, if you're trading in equity markets, especially a Canadian market that relies a lot on exports of goods and services to other parts of the world, you're obviously concerned when you started to see things unfold with regard to COVID, first in China and other parts of Asia, and then obviously it spread to Europe as well before we saw a real heavy number of cases in North America. But obviously the anticipation was that it was going to reach North America and Canada. And so, late in February and even early into March, we were starting to see a downtrend in terms of equity valuations across the TSX, and obviously it was a similar trend in the States if you look at the S&P and the Dow. So a large retrenchment, close to 40% retrenchment from the peak that we had seen towards the end of February, down to a low near 11,000 near the end of March. But it's interesting because I think, and this is obviously reflective of what we've seen broadly in the labor market and also in the housing market over the last couple of months, is I think, the majority of people were looking at how things unfolded and realized that this wasn't a standard recession, if you can ever have a standard recession that's sort of impacted by some factor in the economy, and it permeates through other sectors. This was essentially a healthcare related recession, right? We had a virus for which we have no cure, no vaccine, that's spreading rapidly throughout the world, and the only way to really curb that spread and flatten the curve, was to shut down the most sectors of the economy as a public health initiative. And so I think the realization was there is that, while this was a serious impact on economic growth and on the labor market, it would only last so long as that we had these public health concerns, and until we were comfortable with starting to dial back some of the necessary measures that were taken. And so in fairly short order, we started to see actually a rebound in equity valuations in the marketplace, to the point where, we since that trough that we saw in March, at the end of March, we've gained close to 50% back in equity valuations. So that's an interesting point, and I think it speaks to broader consumer confidence, because if you think about how things have unfolded over the last couple of months in the housing market, people need to be confident in their ability to purchase and pay for a home over the long term, and that sort of wealth impact of equity valuations plays a role, or plays into that confidence in a positive fashion. But as I said, the initial movement in equity markets sort of foreshadowed what we'd see in terms of COVID-19 in Canada. And so this is obviously the number of daily cases in the Ontario context, and we see how quickly those cases ramped up, both in terms of the raw daily cases and then the 7-day moving average as well. So a large spike in March and as we move through April. And then as the public health measures that were undertaken started to take hold and have a positive impact, we started to see those cases trend downwards. And so again, I mean, we went from March 11th. I mean, I'll just take a step back. It seems like forever ago that, you know, we're in the middle of March and the World Health Organization was declaring a pandemic, and you know, we have these sort of large scale shutdowns. The NBA was first, and it kind of permeated through you know, those sort of entertainment sectors, you know, sort of highly visual sort of parts of the economy. But it was only, you know, a few months ago that we are just starting to see the cases ramp up in Canada. Ontario declared a state of emergency a week later. From our perspective, from our industry's perspective, in-person open houses were prohibited. But then, you know, in fairly short order, we started to see light at the end of the tunnel. We started to see, you know, a slight easing in terms of restrictions, with people starting to be able to take on outdoor activity. And I don't think it's any mistake that as we move through the second half of May, and we're starting to see a light at the end of the tunnel, if not a dim light at that period of time, that we did start to see an uptick in market activity in the GTA as well. Because I think, you know, people were looking for some sort of positive bump in consumer confidence, and we started to see that in the first couple of weeks of May, and obviously, you know, I think home sales reflected that as well. Obviously, they gave the go-ahead to dentists, optometrists, and other health professionals to open up at the beginning of June. A big movement, obviously, for the GTA and the economy in general, and in terms of, you know, job growth, was the movement to phase 2, where you saw, you know, a lot more businesses being able to open up, at least in a limited fashion, and that was certainly reflected in both the May and the June job numbers, as we started to gradually see businesses opening up, and also gradually seeing more and more companies become comfortable with the notion of working from home. And then finally, obviously, at the end of this month, the whole of the GTA moved into phase 3. It was a bit of a phased approach, if you will, but the city of Toronto moving into phase 3 also at the end of July. And so I think, you know, certainly it makes sense then that we've seen, you know, strong employment increases over the last 3 months, as well as we've seen this gradual reopening of the economy. And that's what I want to move to now, is talk about some key economic drivers and how they're impacted by that COVID-19 timeline. So first and foremost, and this looks a lot like that equity markets graph that I showed you first, and this is actually from the Indeed blog, and what they show is basically new job postings and where they are relative to the pre-COVID period. And you see that, you know, as we move through March and into April, which was the worst period of time, obviously, for COVID-19, the new job postings on Indeed's platform, they really plummeted. I mean, you were down by more than 2/3 by the time you moved through mid-April. But not unlike equity markets and not unlike consumer confidence, I would argue the business confidence started to improve as well, as we started to see, you know, a gradual reopening start in May, to the point where by the end of July, as the whole of the GTA moved into phase 3, and other parts of the country were moving in the same direction, or had already reopened to a great degree, we were basically back to where we were. And to me, like, that's a really positive sign. I think that, you know, statistics around job postings in a time like this, where it's been a relatively sort of volatile and sort of short-term impacts, both to the downside and the upside. These types of indicators give you a really good impression of what people are thinking of the future. And so if job postings are basically back to where they were in the pre-COVID period, that suggests to me that businesses are pretty confident in terms of where they see their sales growth going in the second half of 2020, and even more importantly as we move into 2021. But if we look at the actual jobs numbers that come out of Statistics Canada, especially for major centers, and on this chart I have the Toronto metropolitan area and the Montreal metropolitan area. We can see that obviously March and April there's a serious pullback in employment, and so to a large degree Toronto, Montreal, and Vancouver accounted for a great amount or a great proportion of the overall job losses that we saw across the country. And a lot of that obviously had to do with it's also in those centers where we were seeing a lot of the cases and a lot of the very stringent public health measures. But it's good to see Montreal opened a little bit sooner than certainly Toronto did, by about a month, and so they gave us a good early indication of what we should expect to see and how quickly we could start to see the job numbers turn around from negative to positive. And certainly we saw that starting for the Toronto area in June with a big jump in jobs, a little bit lesser of a jump as we move through July. But I'd anticipate, as businesses come to terms with the stage 3 reopening and what that means for them, especially consumer front-facing businesses, that we'll see a continued improvement in jobs as we move through August, especially given the fact, and I'm watching the cases on a daily basis, and we haven't, and fortunately in Ontario, seen any sort of spike that could be attributed to the sort of full reopening to stage 3 over the last couple of weeks. Still early days, but certainly good to see that we've seen sort of at least a flatlining in terms of the number of cases, which obviously bodes well for businesses remaining open and people continuing to go out and spend money at these businesses moving forward. If you sort of think about the distribution of these job losses and job gains, obviously it impacted both part-time and full-time segments of the economy. Certainly if you look at July, though, we had a bit of a pause in full-time employment creation, whereas part-time jobs continue to trend upwards. Now, obviously some of that has to do just simply with hours worked. Because if you're sort of gradually reopening the economy, moving from stage 2 into stage 3, jobs that previously would have been classified as full-time may still be in that part-time category as it relates to Stats Can, just because businesses may not be open the full working day, or say have 2 or 3 shifts on, they may be at 1 shift right now, or issues like that. And so that's the other sort of evolution of the labor market that we'll be tracking over the next few months is are we seeing the same types of jobs come back online? And I'd argue that a lot of what was full-time employment in the pre-COVID period, it may initially transition into part-time before moving back to full-time as the economy continues to reopen. But generally positive signs from employment both in the Toronto area and more broadly across Ontario. The other thing I want to point out, because I've been asked a lot of questions, and I know Tim does quite a bit of media in that as well, and it's a common question that, given the nature or the magnitude of job losses that we experienced in a relatively short period of time, how's it possible that we're seeing such a quick rebound in the housing market? And this chart may be a little bit convoluted, but as I explain it, I think it goes a long way to sort of understanding that. Because what this is basically is ranked from left to right. So the blue bars are essentially the job losses that we saw through May across the country. And it's broken down by sector. And if you look at that on the left, the sectors of the economy that experienced the greatest degree of job losses were in that accommodation and food services, wholesale, retail. Those are the 2 sectors that were hit the hardest by this. But it's also interesting, if you look at the orange bars, that's average weekly earnings ranked by sector. and they're also sort of the lowest earning. And so we have this bit of a dichotomy versus what you see on the right-hand side of the chart, where a lot of the sectors that didn't experience nearly as much in terms of job losses are also the sectors of the economy that earn the most on average, that people earn the most on average. And so what that tells me is in a lot of those sectors, people were able to fairly quickly transition their operations from the office space to the home office. And so, you know, a lot of those individuals found in fairly short order that, you know, or became confident in fairly short order, let's say, that, you know, they'd be able to gain and retain employment over the longer term. And so as interest rates edge lower, you know, a lot of these individuals actually saw an opportunity to get back into the market, especially as a lot of their realtors, those of you that have taken advantage of new technologies like live stream open houses and what have you, you know, a lot of these individuals were able to move back from the sidelines into the housing market in fairly short order. And that's a nice segue into borrowing costs, because that's obviously, you know, it wasn't as much of a factor early on, like in March and April, when the Bank of Canada cut its overnight lending rate, its target rate, very quickly and aggressively. Those cuts weren't necessarily meant to immediately spur on the economy in March and April, because people essentially weren't able to take advantage of low interest rates because they, you know, most things were closed. And certainly from the real estate market's perspective, we're still going through a bit of a transition in terms of how are we going to go from, you know, traditional bricks and mortar type of selling into a more of a virtual world, and certainly dealing with social distancing and what have you. And by and large, our industry has translated well. And so as we moved into May, and certainly more so June and July, and interest rates remain very, very low and will remain low for the foreseeable future, obviously that's been a positive factor, you know, influencing strong sales and record sales in July. And so just to give you a sense, there's only been a couple times in history where you've seen the Bank of Canada's overnight lending rate at 25 basis points. Obviously, the first time that took place was in the recession in 2008, 2009, and then again, obviously this year. So a lot of your clients are taking advantage of longer term mortgages, specifically 5-year mortgages, which are based in large part on the cost of raising funds in the bond market. So just to give you a little bit of a sense of how that looks, over the same sort of period of time as we move through January and into February, and as we start to see more concerns about, you know, economic growth, we saw the chart with equity markets earlier on in the presentation. You also started to see bond yields drop off in anticipation of central banks in developed countries around the world dropping interest rates in order to, you know, spur on economic recovery as quick as possible. And so it wasn't surprising to see bond yields drop off, and that gives us a good idea, the blue line, it gives us a good idea of what it costs lenders to raise money to turn around to lend out to your clients in the form of a mortgage, which is the orange line. And that's the average contract rate. So this is obviously much lower than the posted rate that we see on the Bank of Canada's website. This is taking the average actual contract rate for funds dispersed for transactions. And so certainly right now, if you sort of look at that average, you know, we're less than 2.5%. And certainly if you go online, you know, you're able to see some, you know, heavily discounted mortgage rates below 2% right now. But I think, you know, by and large, if you look at the forward rate for bond yields, the cost at which lenders are going to be raising money, and sort of look at how that's translated through into average contract rates over time, it's certainly reasonable to assume that on an average basis, at least, we'll see, you know, that 5-year rate hovering somewhere between 2 and 2.5% through the end of 2021. And so this goes a long way, obviously, of explaining how or why, you know, we've continued to see strong demand for ownership housing in the GTA. I mean, basically, you know, in the summer of 2019, we were seeing the rate in and around 3.5%. As I said, some of your clients are taking advantage of 5-year funds likely at or below 2% right now. So let's take a quick look at how that's sort of translated into sales and listings and price through TREB's MLS system over the last few months. And it's important to note that we saw a really strong handoff in terms of both sales and price from 2019 into 2020. We saw strong growth in January, February, and March on a year-over-year basis. We weren't quite back to those record levels that we'd seen in the first quarter of 2017, but it was shaping up to be a strong year. And then obviously COVID-19 hit, and we saw a terrible April where we had less than 3,000 sales entered through TREB's MLS system. Certainly an improvement in May, but we really started to see a recovery in sales and people moving off the sidelines and back into the market in June, where we were almost at 2019 levels, and then July, where we popped up to a new record, over 11,000 transactions in July. And I think Tim hit it on the head. It was a bit tongue-in-cheek, but we really are seeing the spring market in the summer. And essentially, you have households now that they're not traveling as much as they normally would. You have households that also had every intention of making the purchase of a home in April and May. Their economic situation didn't necessarily change a lot. As I said, a lot of people who are sort of in those home buying cohorts today are working in those sectors that were able to make that transition from the office to the home office. And so, many individuals over the last couple months have determined that, they're confident in their ability to purchase and pay for a home over the long term. So we're seeing the numbers that we saw in January, February, and March pointed towards spring numbers that were not unlike what we saw in July. So it's not surprising to me that we're starting to satisfy some of the pent-up demand that built up in April and May, simply because people weren't able to get out or weren't necessarily confident yet in their ability to make that large ticket purchase. Listings are also up. We'll talk in a bit how there is definitely an asymmetry between different segments of the market in terms of what's going on with both sales and listings. But it's good to see that we did at least see some increase in new listings, both in June and more so in July. I mean, everyone likes to see the values of homes going up over time. But I don't think anyone likes to see on a sustained basis, high single digit to low double digit price growth, because that leads to affordability concerns. It also leads to sometimes policy decisions, as we know, that aren't necessarily the most efficient for the marketplace. And so ideally, what we'd see is listings moving in lockstep with sales. But for obvious reasons, and we'll discuss it a little bit more, while we have seen an increase in listings, it hasn't been as strong as that increase in sales. And so market conditions are tightening up. And for that reason, because we've had such a constrained supply scenario in the GTA over the last few years, that's starting to come to the forefront again. It's easy to forget about the supply issue when we move into a serious economic period of time like COVID-19 brought about. But as you start to see that pent-up demand get satisfied, and we're still facing that lack of listings, that lack of housing stock really in the Greater Toronto Area, it's no surprise then that we've seen a pretty quick acceleration in price growth over the last couple of months to well over $900,000 if you look at the average price across all home types. And this just gives you a sense. I mean, we're looking at it sort of on a year-over-year basis there, but this chart it really provides sort of a stark view of how quickly things dropped off, but also how quickly things have recovered. So we take out those sort of regular seasonal variations that we see each year in the marketplace, and allows us to look at a clearer trend over time. And it really was, people are talking about, it's just will we see a V-shaped recovery? Will we see a U-shaped recovery? This is very much a V-shaped recovery. Whether you're looking at sales or new listings, we're back to and even above the levels that we're seeing in the first quarter of this year. Again, not necessarily back to the sort of the record levels from a listings perspective, But certainly from sales perspective, very strong numbers, especially as we move through July. But that's interesting because ideally we'd see, listings getting back to record levels as well and providing a little bit of balance in the marketplace, but we're not there yet. And so we've actually seen market conditions tighten over the last couple of months. And that can be seen when you look at months of inventory. So that's another indicator of market tightness. And the simple math for it is you're taking active listings at the end of the month and saying, if we didn't see any more listings come online, and given the current level of sales, how long would it take to deplete all of the inventory in the marketplace? And that jumped up temporarily to about 4 months, 4.5 months, as we in the early days of COVID-19. But as we've seen sales increase at a quicker pace than new listings over the last couple of months, you've seen that months of inventory indicator drop down again to below 1.5. And at that level, on the whole in the marketplace, I mean, that's pointing to, low to mid double digit, price growth over time. We're not quite as tight as where we were back in 2016 and 2017 when we started to measure inventory, not in months, but in weeks or even days in some neighborhoods. But suffice to say, the market's tightened up in a hurry, and we're back to levels that we were seeing at the end of last year and beginning of 2020. And that's why we are setting new records in terms of average price. Again, a very quick recovery there. Market conditions have tightened up very quickly, especially as we'll see in the low-rise segment of the market, detached, semis, and townhomes. And so we've seen that average price, push above the peak that we saw back in early 2017. But as I discussed a little bit earlier, the recovery hasn't necessarily been uniform across all segments of the housing market. And so, for example, what I've done here, if you look along the bottom of this chart, it's just sort of breaking the market down into 4 major segments: detached, semi-detached, and townhouse obviously make up those low-rise categories, and then condominium apartments. And so if you look at the detached marketplace, and what we're looking at here is June and July. So I'm looking at the months of June and July sales and new listings in that 2-month period in 2020 versus that same 2-month period in 2019, just to get a sense of how this recovery is unfolded versus the levels that we were seeing last year. And sales of detached homes are up dramatically compared to last year, whereas new listings are more or less flat. So much tighter market conditions in that detached market segment compared to what we saw last year. We've seen sales and listings of semis more or less move in lockstep. That was already a really tight segment of the market this time last year, and continues to be over the last couple of months. It makes sense. It's sort of a key entry point, especially in the city of Toronto, for people looking to get into that low-rise segment of the market. So it's been tight for a long time now, and continues to be. Townhouse market segment as well. It's good to see that we did see sales and listings move more or less in lockstep, but a bit of tightening there as well. It's the condo market where we've seen more of a divergence. So we've seen sales actually off on a year-over-year basis over that 2-month span, and listings up dramatically. And so obviously there's some reasons for that. It's been more difficult to show and get into view condominium apartments versus low-rise homes. And on the listings front, there's been a number of factors that have played into increased listings in that segment, and some of them are starting to come into play even before COVID-19. Our Ipsos polling at the end of last year, which included speaking with investors, found that there's a good number, above 50%, that were considering listing their investment property for sale as we move through 2020. And obviously in the condo market, there's a few things that impacted that. We were seeing stricter regulations around short-term rentals. We were seeing the prospect of vacancy taxes in the Greater Toronto area. We were seeing more supply coming into the rental market as well, which was starting to exert downward pressure on rents. And then on top of that, during this period of time, you had COVID-19, where it was becoming, more and more difficult, or at least it was becoming unclear in terms of what direction, your investment was going to go over the longer term. And so I think in that condominium apartment marketplace, we've seen a lot of COVID and non-COVID related factors that have fed into, you know, more investors listing their units for sale. And on top of that, you're also seeing that natural progression through the marketplace, where people are listing their condominium apartment for sale in order to move into another segment of the market, detached, semi-detached, townhome, and what have you. So the bottom line is that, you know, if you look at the sales to new listings ratio, which is the blue line for detached and semi-detached houses, it's quite high from a historic perspective, between 60 and 70%. And so once you're getting into that territory, you're going to get into the, you know, double-digit year-over-year price growth, and that's certainly what we're seeing for both detached and semi-detached homes. Townhouse market segment is also tight. We're not seeing quite as much price growth there compared to detached and semis, but some of that is compositional, at least on this chart, because I'm kind of blending together condo towns and freehold. But suffice to say, you know, that segment of the market holding up very well in terms of price growth, just based on very tight market conditions. If you look at the sales to new listings ratio, however, for condominium apartments, it's hovering in around 40%. And so while we are seeing still pretty strong price growth, which I think is a bit of a hangover from what we were seeing late last year and in the first quarter of 2020, that market certainly is becoming a little bit more balanced. And I think as we move forward, the condo segment's contribution to overall price growth will probably lessen over the next few months as buyers in the marketplace start to realize more and more that there is quite a bit of supply out in the marketplace. There's quite a bit of choice, and so they may be able to be a little bit more aggressive with their offers. And the supply sort of situation, especially in the condo market, has also played itself out in the rental market as well. And really since the end of 2019, we've actually started to see a downward trend in average rents. And it's really that supply-demand relationship that bears that out. So if you look at this blue line, you know, we're seeing extremely tight rental market conditions with a rent-to-list ratio in 2017 and 2018 at 80 to 85%. So it's not surprising during that period of time, if you look at the gray bars on the right-hand scale in this chart, you know, that average rents are both growing in the double digits. But we started to see more and more units being listed for rent, you know, within the traditional rental market. I think a lot of that had to do with investors who were operating within that short-term rental space, starting to look more and more closely at you know, traditional leases in order to make a return on their investment. And so you did certainly see more supply coming online in the pre-COVID period as we moved through 2019. And then obviously on top of that added supply over the last few months has been the fact that the demand for rental hasn't been there. Number one, we saw earlier some of the lower wage segments of the economy that are often pointed towards the rental market. They were hit the hardest in terms of job losses and what have you. So that would have precluded people signing leases to begin with. On top of that, migration, you know, worldwide essentially ground to a halt. And so the rental market in the Greater Toronto Area is driven by immigration. It's driven by non-permanent migrants, including students as well. And so as that dries up, you're also seeing a lessening in demand for rental properties also. And so, you know, obviously as we move through the first and second quarter of this year and rental conditions softened up, we've actually seen the first, you know, year-over-year declines in average rents for many years now. And so it's definitely a market that's transitioned fairly quickly over the last year to year and a half, and COVID-19 sped up that transition by impacting the demand side while supply was continuing to grow in that rental market space. So that's sort of the housing market in a nutshell in terms of what we've seen as we move through the first half of 2020, and it's been, you know, pretty volatile in terms of what we've seen. Excuse me. But there's other factors at play that have been impacting the market over the last couple of years, aside from COVID-19. And a lot of that's been on the government policy side. And a recent concern has been announcements by CMHC. And so obviously we've seen new stricter underwriting guidelines where debt to service ratio, gross debt service ratios and total debt service ratios there's been a lower ceiling now applied. It used to be, gross debt service. So principal and interest, property taxes and utilities couldn't account for more than 39% of your household income before taxes. That's now 35. Total debt service, so looking at just your total debt service, whether it's mortgage, credit cards, everything else, can't account for more than 42%. And the minimum credit score is higher. And then finally, and probably the bullet that could potentially impact the most is that non-traditional sources that increase indebtedness, so borrowing from another channel in order to increase your down payment, is no longer allowed if you're going to qualify for CMHC mortgage insurance. But it's interesting because whereas in the past the convention was when CMHC made changes, their private sector competition, namely Genworth and Canada Guarantee, would more or less follow suit. But that hasn't been the case. And so what we've seen is a scenario developing where CMHC has been losing market share, especially as we've moved through this recovery period, to the benefit of these other two mortgage insurers who didn't enact as stringent underwriting guidelines. And so that led to yesterday's news. This is a screenshot from BNN yesterday morning, where they reported that a letter had been sent by CMHC's president, Evan Siddall, to various lenders and organizations representing those lenders, talking about the market share issues, and basically saying that lenders should reconsider offering mortgages that aren't subject to these these stricter guidelines because there could be economic implications moving forward. So oftentimes when we see changes to mortgage lending guidelines, there's often this concern that there's a huge proportion of deals getting done where people are putting 5% down or between 5 and 10% down. And obviously the concern is that, if this is widespread enough and we see a downturn in the housing market, then a lot of these mortgages would be underwater, and it could lead to a scenario that we saw unfold more so south of the border in 2008 and 2009. But we have been tracking this through our Ipsos polling each year, both in the fall and the spring. And what we find is that there is a diverse source of down payments, both for all home buyers, but then also first-time buyers. Obviously, savings outside of RSPs are generally the single greatest contributor to a down payment. Within RSP is obviously a greater contributor for first-time buyers. And then gifts account for a larger component. And then I count equity from a current home when you're talking about first-time buyers is essentially a gift, because I think essentially what those first-time buyers are saying is that, look, at our parents took some equity from their current home, or someone that we know took some equity from their current home to help us out with the down payment. So if you put those two together, gift obviously accounts for a substantial portion of down payment for first-time buyers as well. But by and large, people who are looking to purchase a home, whether they're first-time buyers or moving around somewhere within the ownership market, they're getting their down payment from a number of different sources. And what that adds up to, and as I said, I'm going to send around a PDF version of this presentation, so some of you may not be able to see this that well. But what this sort of breaks down, number one, is what the average down payment amount is for different parts of the GTA and also first-time buyers. And what we've seen pretty consistently over the last few years is that number is always well above 20% on average. And so whether you're a first-time buyer or whether you're moving around in the marketplace, that down payment is on average above that 20% threshold for mortgage insurance anyway. And so then if you look at the bars at the bottom of the chart, you'll see that, if you look at all the people who purchase a home or what percentage of their purchase is going to be covered, or who are intending on purchasing a home, what percentage of that home, or what percentage of that down payment would be, you see it's fairly low numbers that we're saying they're going to put between 5 and 10% down. Somewhere between 15 and 20% were in that sort of 5 to 15% category. And so, the majority of people were putting 20% down or above, even in that first-time buyer segment of the market. And I think that's important to point out because, I think there's often the notion out there that the great majority of people, especially on the first-time buyer front, are extremely leveraged. And, we've seen consistent results from our polling over time, both talking with people who have purchased a home, as well as people who are intending on purchasing a home over the following 12 months, say that they're going to have a down payment, at or above that 20% mark. And so I guess it calls into question, at least to a certain degree, some of the concerns around high ratio mortgages and the level of indebtedness, especially given that we've seen a number of changes to mortgage lending guidelines over time, and you continue to see strong demand, including in that first-time buyer category. And so that suggests to me that oftentimes first-time buyers, as well as just households in general in the Greater Toronto area, aren't given enough credit in terms of keeping their household balance sheet in order and sort of managing their finances in an affordable manner. Just sort of looking forward into the future, as I mentioned, we did undertake some smaller sample surveys during the COVID period. Both in March and then again in April. And what we found is that home buying intentions didn't move a heck of a lot compared to what we saw in the spring of 2019. The credibility interval for these types of surveys, or this type of sample, is in and around 4 percentage points. And so if you look at 31% of people in the spring of 2019 said they're very likely or somewhat likely to purchase a home, well, that number dipped to about 27% both in March and April when we undertook these surveys. That's more or less within that credibility interval. So by and large, home buying intentions had remained strong, which gets to that notion of pent-up demand. There are a lot of people that even during March and April, which were pretty dark months in terms of the economy, we're still sort of looking ahead saying, yeah, I'm going to purchase a home over the next 12 months. And that sort of definitely led us to believe that there's a lot of pent-up demand building in the marketplace. And obviously we started to see that be satisfied in June and even more so in July. The more concerning number is obviously on the listings front, and we've talked about this to a certain degree already. In the spring and fall of 2019, somewhere between 30 and 39%, or 32 and 39% of people surveyed said they were planning on listing their home for sale over the next year. That dipped down to 17 and 21% in March and April, respectively. And so if this dichotomy between listings intentions and selling intentions holds as we move through the second half of 2020 and into 2021, that obviously has implications for very tight market conditions and accelerating price growth, which brings us to the topic of government policy in a little bit more detail, because we've been really banging the drum at TREB, and I know many realtors across the GTA have as well when they interact with public officials. We've been really banging the drum on the supply side of things, and to their credit, if you think about municipalities like the City of Toronto, and if you think about the current provincial government, they get it, and they've acknowledged that there is a sustained and systemic supply issue within the housing market in the Greater Toronto Area and in other markets throughout Ontario. And we're starting to see action on that front. The City of Toronto is looking at implementing strategies to see a greater degree of sort of mid-density homes being built throughout the Greater Toronto Area. So sort of filling that gap that right now exists between, say, the condominium apartment and the detached home. And from the provincial perspective, they're looking, more and more closely at transit-oriented development around both new subway stations and new GO stations that are planned in conjunction with various transit initiatives. I think obviously we could go further. I think one area that we're not looking at probably enough is employment lands. Where you have a lot of employment lands that probably aren't seeing their highest and best use even from an employment perspective. And so I think there's opportunities for higher order employment and residential uses to commingle a lot more. I think of areas like Downsview and that kind of, and those type of areas where probably opportunities exist as well. And so I think municipalities in the province are headed in the right direction. I think from CMHC's perspective, Tim's right. I worked there more than a decade ago now, but there's a lot of people at CMHC who have studied the housing market for a long time, and I think that resources could be put towards working with other levels of government and working on national strategies, even to see more supply come online, and perhaps doing research to dispel some myths around, if you see infill development in some neighborhoods, the property values are going to decline and what have you. That type of research would be more beneficial than I would argue researching, taxes on capital gains and what have you. And so my hope is that we also see similar initiatives on the supply front coming from the federal government, and particularly CMHC as well, in the coming months. So obviously our current forecast update, which we released at the end of June in conjunction with our regular market release, was looking at somewhere in the neighborhood of 80,000 sales this year. And I did mention that depending on the acceleration of the economic recovery, we could move above that number. But there's also the other side of that coin, where if we do see an uptick in cases, we haven't seen that in Ontario. I think by and large we've been very responsible in Ontario in terms of our social distancing, in terms of wearing masks. And I think that's put us in good stead so far. In other provinces, we have seen an uptick in cases as you've seen a gradual reopening of the economy. And so obviously, if we did move into a scenario where there is a second wave and stricter measures have to move back into place, that could obviously impact demand. And so, I haven't moved to sort of change that forecast on sales or on price for that matter, sitting at about $900,000. We're at 903 on average for the year at the end of July. We'll continue to monitor it. Probably the next forecast update I do will be at the end of the third quarter, at the end of September, and I think we'll have a much better idea of which way this recovery is heading as we move through August and September, and then we start to see the prospect of kids going back to school and what have you. So we're 2 months in, a relatively short time series with which to make judgment calls on, but it looks right now, at least in the Ontario context, that we're headed in the right direction. And so I anticipate pretty strong demand for home ownership as we move through the second half of this year, and fairly tight market conditions, especially on that low-rise side of the market. So that's essentially what I have today in terms of formal presentation, but I'm certainly happy to turn it back. I think Tim's had to leave us, but I'm certainly happy to turn it back to I guess Larry if there's questions from the group. So I'll turn off the presentation now and turn my camera back on, and we can have a discussion.
Thank you, Jason. As usual, I mean, I've been very fortunate, just like Tim has, to have you around, and honestly, folks, you've it's hard to put my finger on it, but Jason's just an incredible source. He is an amazing guy. What I love about Jason is the fact that he'll put it in layman's terms and explain things basic. He can get very technical if we have to, and you don't want to see that, because I've seen that at the City Pulse when he did it a few times with Mr. Drew. But having said that, I appreciate the fact that you said the transactions would be roughly at the year's end around the 80,000 mark, give or take. We had projected in January actually around 90,000, obviously not knowing COVID was going to hit.
Sure.
What I'd like to ask you though, Jason, if you don't mind, then we're going to open it up to some of them. Just a personal question. I know you, and I know how you study the stats right across the country. How do you see us compared to, say, the national body? Because, you know, we have a lot of people that, a lot of our reps here that work with some of their clients that watch the news, but they don't see,
Sure.
they see news and they might be talking about Edmonton, Calgary, and all that. So they get, oh my God. If you don't mind maybe addressing that, then and I'll
Sure.
ask Rebecca to maybe follow who's on and who's going to ask questions. Okay, please.
Sure. Yeah, and you know, it's a good point, because just like I talked about, you know, we haven't seen in this short period of time recovery unfold in a uniform fashion across the different segments of our market. I think that's the case certainly across the country as well, because there's other intervening factors. Like if you think about markets like Toronto, Montreal, and Vancouver, all of them have fairly diverse local economies, a lot of, you know, consumer-driven you know, economies there, higher order employment. And so, you know, the recovery for those markets will be different and probably more positive than, say, what we'll see in some of the prairie provinces, especially, you know, Alberta. Like you know, whenever possible, I you know, have discussions with my colleagues across the country at the various associations and CREA. And certainly, you know, when you talk to the folks in Alberta, I mean, to a certain degree, it's almost difficult to break out the oil and gas impact and the COVID impact, because, you know, you're seeing sliding sales in the major markets in Alberta, you know, before COVID hit. And so, you know, there's kind of these commingling factors that we didn't necessarily, you know, we weren't running up against here in the GTA, for example, where the unemployment was, you know, nearing historic lows as we went into the COVID period. And I think, you know, that gets me back to, you know, where you have markets, whether you're talking about the GTA or other parts of, say, Southern Ontario, where you have markets that, you know, a lot of the economic base is driven by, you know, professional services, office-based employment that in fairly short order could move from the physical office to the home office, then, you know, a lot of those people are still collecting a full paycheck. And a lot of those sectors of the economy are still doing reasonably well. And so that's where, you know, the ownership demand is certainly coming from. And I think you see that dichotomy in the labor market when you look at the ownership market versus the rental market, because the rental market softened quite a bit. And generally speaking, the rental market caters towards, you know, sectors of the economy that are making, whose wages and salaries are less on average, or, and this is an important part too, that it caters to people who are initially arriving in Canada from other parts of the world. Stats Canada did a really interesting study a few years back where they tracked a sample of recent immigrants over time. And what they found is certainly, you know, the majority of newcomers initially rent, which makes sense. They're going to get their feet on the ground, they're going to get a job and start working. But in fairly short order, you know, they move into that ownership market. It's a key goal for a lot of newcomers. And so, you know, there is that sort of gap there where you're not seeing that same level of rental demand, because essentially the taps have been turned off in terms of immigration, in terms of even part-time migrants, say students and what have you, that would feed that demand on the rental market side.
Jason, another point, and I know a lot of our reps here have been dealing with, and this is, I'm going to talk from a managerial point of view, because I've been getting a lot of calls about how they were doing deals outside of the GTA, which they become almost the norm, where before they were going, I wouldn't go that distance, but now they are going that distance, and the impact about how many of the actual TREB per se people are doing deals in places like the, St. Catharines and so on and so forth.
Yep.
And again, hopefully we're going to have some good questions from some of these people, I hope, in about 2 seconds. So if you, again, maybe you can just maybe talk to them.
Yeah, I'm happy to comment on that. I think John D. Michelle was in speaking with some of you as well, and he may have alluded to it, because if you look at, especially since, say, 2012, and 2012 was an interesting period of time because you did see a lot of changes to mortgage lending guidelines, and we talked about that a little bit earlier. But I think, I think what you started to see is people were sort of looking beyond the traditional borders of the GTA and the TREB primary market area, because, obviously there's qualification issues. And so you start to see more and more people helping their clients look for places, in the Guelphs and Barries, St. Catharines and Hamiltons. And that's been sustained because all of a sudden now, realtors are an entrepreneurial bunch. And so, if you're helping a few of your clients get settled in some of these areas outside of the GTA, well, sometimes that's a virtuous circle, if you will, because you start to understand those markets and you can help more and more of your clients, and you get referrals for those markets as well. And so now if you look at the TREB sales, not just in our primary market area, which we report on in the Market Watch, but broadly across, all of Ontario, you're getting on, 20% of overall transactional activity through our MLS system is in those areas outside of the GTA. That's a big number. And sort of, the reach of, our membership base has been growing certainly over the last decade.
Great. Rebecca, do you have anybody there that may have some questions, or anybody at this point? It'd be great.
There's no questions yet in the chat, but if anyone wants to turn on their mic, they can feel free to do that.
Yes, please feel free, or put your hands up, or whatever you're doing, or ask a question of Jason. Take it. Oh, Andre, beautiful. Do you mind? Go ahead, bud. Just.
Hey, Jason. Thanks for everything here. It's great.
No problem.
My question is, I know you did speak about this in many different ways, but I wanted to kind of, maybe if you can summarize it. There was a deep freeze in March, April, and then all of a sudden there was a lot of talks about a second wave hitting in the fall once school kicks in. But I get clients asking me quite often is, why is the market so crazy right now? Why are people jumping in like there's no tomorrow, and it's going to continue going up, so we got to get in now? Like this is we could say it's the spring market, the late spring market, or the delayed spring market, but this is kind of unusual, and I want to hear your take on that.
Yeah, I think a lot of it's that, once the dust settled from the early days of COVID, and let's call that, from the first half or second half of March to the first half of May, over that 2-month period, you're seeing a lot of people who were working in segments of the economy whose wages supported home ownership, professional services, finance, those type of jobs, found that, they didn't miss as much of a beat, let's say, as they initially thought they would have. So people are working from home. They're still able to do their job by and large. All of a sudden they're feeling a lot more confident in say June than they were back in April that they're going to retain their employment. Interest rates are now, you could take on a mortgage for 2% or less potentially. And so that's a huge positive factor in terms of affordability. People start moving back into the market, because don't forget, there are a ton of these people that were sitting down at their kitchen table in January and February saying, well, yeah, like we're going to purchase a home this year. They're starting to ramp up with their realtor and what have you. And then things just sort of pulled back. And so those people didn't go away. They just kind of moved to the sidelines and started coming back into the marketplace in July and August. So, I mean, I know it's become almost a bit of a cliche, but there certainly is a bit of that spring in the summer mentality, just because, this was a relatively short-term downturn in the market, in the sense that, it was really bad for 2 months, and it's gotten, pretty good again over the last 2 months.
Anybody else? open there. I'm sorry, I don't see everybody. So just in case you want to go through anybody.
And I'll send you the presentation, Larry, and
That
then,
would
you know,
be
if anyone's got any questions, they can always reach out to me as well.
I have just one last question here, and then because I know your time's valuable, and I know the demand you have. Probably before we end up, you're going to be on Global this afternoon. Or
I'm
something.
always happy to talk to you guys.
Yeah. I just wanted to ask you, you know, you made a comment, and I agree with you. A couple of days back, I was talking with some of the reps and some people, good friends of mine, saying, you know what, do not be surprised. You're going to see a lot of these like bank buildings, industrial buildings, possibly being changed or converted for zoning into residential because of the fact, like you said, a lot of people are working from home. They're going to see that this might be not a bad idea. We cut the costs. We're going and conversions of some of these buildings into investment properties. Andre, listen up, buddy. So those investments might be happening faster than you think, where there is going to be some conversions. Believe me, just like they did many years ago, the lofts into rentals and so on and so forth. What do you think? Do you believe that's possibilities?
I mean, I think the commercial market, and just like when I was talking about Alberta, the commercial market already had some forces at play that were sort of impacting it even before COVID. So thinking about, you know, online purchases and that type of thing. And when we had the commercial webinar with Ray Wong from Altus a couple of months ago, you know, one of the things that he brought up was that, you know, especially in terms of, you know, in industrial space, you know, you're probably going to see, you know, some conversion of that space, or even like traditional mall style and warehouse style retail space, you know, maybe converting into more, you know, logistical platforms for like online buying and that type of thing, or pickup points for people buying online, but not necessarily having it delivered to your home. And you know, one of the examples that he pointed to in the US was JCPenney being bought by Amazon. And Amazon's not looking to get into the bricks and mortar retail game, but what they are looking to get into is you know, having a better delivery network so that they can offer you know, faster delivery to a broader swath of the population. Because it's one thing to give you same day delivery in a center like Chicago or Toronto or Vancouver. It's another thing maybe in, you know, Duluth or Saskatoon type of thing, right? And so, you know, if they're able to take advantage of well-placed retail that isn't necessarily viable anymore, but it's still close to people's homes, either for a delivery spoke or for a pickup point, then, you know, I think that they're looking at that. I think the smaller retail is interesting because, you know, and I'll just speak from a personal anecdote. Like I live in North Toronto and I don't do a lot of driving anymore. Like, I mean, you know, most of my day-to-day purchases are made by me walking to the store with a backpack or biking or something like that. And so, you know, I think that may be an interesting sort of space that, you know, if that type of behavior or change in behavior holds, even, you know, as we recover from this, you know, are we going to see more demand for those sort of local storefronts, both in terms of, you know, local businesses, but also say smaller footprint stores from, you know, more traditional and larger retailers and that as well. Finally, on the commercial front, I think, you know, what's really going to be interesting is is office space. I think, you know, it's easy to say, hey, everyone can work from home, so that's what's going to happen. But I do think that there is a certain degree that or to a certain degree, people miss, you know, sort of that sort of change between home and work, and also the you know, the communication that you have and socialization that you have with people in the workplace and that type of thing. But, you know, it's definitely going to be, you know, different. I mean, right now with the you know, social distancing practices in place, I mean, it would take hours to fill up a building like First Canadian Place in the morning. And so I think that's, you know, how that plays out is more longer term and probably, you know, plays itself well into like 2021. Hopefully we have a vaccine and hopefully it's deemed to be, you know, pretty effective and that type of thing. But I think, you know, you'll start to see, you know, more essential services that are more easily done within the office environment start to go back, but a lot of people will remain at home. But, you know, long term, a lot of those AAA office space properties are owned by, you know, pension funds and what have you, who need, you know, who obviously need to provide those returns to unit holders. So I think, you know, eventually there is going to be a push to see, you know, more people back in the office and what have you.
Well, Jason's, like I said, and I promise I was going to be nice. As you notice, I probably have a halo over my head as you keep seeing this.
You do, yeah.
Yeah, right. You know what? If we do not see any other questions, I'm just going to say on behalf of ourselves, Tim, and everybody that, you know, honestly, thank you so much. We look forward to always having you back. We'll hold you on record that, you know, we will get you back maybe in October, maybe November, even whatever, and get you back because I know we enjoy it. And honestly, thank you so much. Rebecca, I'll let you close it out. And thanks.
There was another question.
Oh, there is?
Oh, there was?
Yeah.
I'm happy to answer it.
We have one question from Jenny in the chat saying, what's your personal take on the market if the virus gets a second wave?
Yeah, and I addressed that to a certain degree in our June release, in the sense that, you know, what I said is that if we continue to see the market sort of play itself out, as if we, you know, see the spring and the summer and that kind of thing, and that plays itself out through the fall and winter, then, you know, 80,000, maybe even above, makes sense. But I predicated that on, you know, if we have a scenario where we see stage 3 revert back to stage 2, or even back to stage 1, if there is that resurgence in viruses, then obviously it's gonna do a couple of things. Number one, it's just gonna preclude people from spending money in a lot of cases, and that's going to feed through negatively into consumer confidence. And so it's difficult to put an exact number on it. Like, would it be reasonable to say we go back to April numbers? Probably not, because people evolved. You know, our industry, you know, we use technology well. And I think, you know, a lot of TREB members are taking advantage of live stream open houses, the Matterport type technologies and what have you. And so, you know, I think there's been an evolution there that won't go away. Like, even, you know, moving forward, 2021, 2022, if COVID's not as much of a concern, you're going to see more tools being used to sell a home than, say, a traditional bricks and mortar open house and what have you. So I don't necessarily think that even if there's a resurgence in cases and we kind of have a step back from, say, stage 3 or stage 2, that necessarily gets us back to April numbers. But, you know, we'd probably definitely come off, you know, the record July numbers in that as well. So I don't want to put a specific number. That's why I'm sort of sticking to the 80. I mean, right now, if we see July numbers carry on through the end of the year, it'll blow that 80,000 mark out of the water. But I kind of have that there because, you know, there is the potential that things slow down a little bit too as you move into the fall, especially if the case count goes up.